Welcome to the lounge once again. My name is Trey Clark, and this is where the truth, the narrative, and reality all intersect. Stay tuned.
NVIDIA reaching a $4.8 trillion market cap while data center revenue accounts for nearly 90% of its total sales isn't just a corporate milestone, it's the defining signal of a market that might be decoupling from traditional reality. When you look at the sheer scale of the AI infrastructure boom, it's hard not to notice the friction between these massive valuations and the physical toll being extracted from the planet and rural communities. We're seeing a $1 trillion capex cycle for data centers by 2026, but the question is whether the stock market is discovering true price or just engineering short-term volatility for the benefit of a few insiders.
It's a multi-layered crisis of scale. NVIDIA generated about $216 billion in total revenue in fiscal 2026, and nearly $194 billion of that came directly from the data center segment. That kind of concentration is unprecedented for a company of this size. Analysts are now looking at a cumulative $1 trillion in Blackwell and Rubin chip sales through 2027. But as you mentioned, this isn't happening in a vacuum. To build these AI factories, the industry is essentially mining the future of rural water and global labor. A single hyperscale facility can pull 5 million gallons of water a day just to keep the servers from melting. Google's own sustainability reporting showed their consumption jumped to 10.9 billion gallons in 2025, a 34% increase in 1 year. We're effectively trading local aquifers for model training time.
The environmental cost is often treated as an externality, but it's becoming a very direct conflict in places like Arizona and Georgia. Communities are reporting depleted aquifers, yet the capital keeps flowing in because the market sees AI as the only game in town. I find it suspicious how these massive infrastructure plays coincide with what looks like highly coordinated market movements. Take April 2025, for example. We had that 9.5% surge in the S&P 500, one of the largest single-day gains since World War II. It wasn't just a random rally, it was preceded by a social media post at 9:37 a.m. declaring it a great time to buy, followed hours later by a policy U-turn on tariffs. That's not price discovery, that looks like a signal for those in the know.
The timing of that tariff pause was surgically precise. If you look at the options data, call volumes spiked 20 minutes before the official announcement. S&P 500 tracker funds saw massive contracts traded just as the news was about to break. It suggests a significant information asymmetry, where policy decisions are being front-run by sophisticated actors. And it's not limited to the traditional equity markets. We're seeing the same pattern in prediction markets like Polymarket. There was one account that netted over $600,000 just by betting on the timing of military movements in Iran with 93% accuracy. When you have U.S. Army Special Forces soldiers being charged for using classified info to win six-figure payouts on these platforms, as happened in early 2026, the wisdom of the crowd starts looking like a cover for well-placed leaks.
It creates a perverse incentive structure. If a Pentagon staffer or a White House aide can make more money on a Polymarket bet than their annual salary by leaking a strike window, the integrity of the information environment collapses. Meanwhile, retail investors are being lured in with the democratization of trading. They now represent 25% of all market activity, but they're playing a game against high-frequency algorithms that increase intraday volatility by 30%. These retail traders are piling into zero-data expiration contracts, zero DTEs, which are essentially lottery tickets that institutions use to harvest premiums. The house always wins when the house is an algorithm that can react in microseconds.
And the house is expanding into the heartland. About 67% of new data centers are now being built in rural communities, particularly in the Midwest and South. These towns see the immediate tax revenue and the construction jobs, but they don't see the long-term risk. These facilities are incredibly resource extractive and surprisingly low on permanent headcount once they're operational. If the AI bubble pops or if a more water-efficient region offers better subsidies, these towns could be left with massive hollowed-out concrete shells and exhausted water tables. It mirrors the historical boom and bust cycles of coal mining or oil drilling. You drain the resource, you leave the infrastructure to rot, and the community becomes a ghost town.
The extraction isn't just domestic either. The silicon, lithium, and cobalt required for these high-performance chips involve a supply chain that is often brutal. Over 70% of the world's cobalt comes from the Democratic Republic of Congo, where roughly 40,000 children are estimated to be working in artisanal mines. We are powering the agentic AI workloads of the future with labor that hasn't changed since the 19th century. Yet, when you look at NVIDIA's 75% gross margins, the market doesn't seem to care about the ethical or environmental debt being accrued. It only cares about the next quarterly beat.
That's the core of the problem. Equity valuations don't account for the unjust supply chain or the geopolitical destabilization required to maintain them. Instead, we see engineered volatility. The April 2025 cycle was a perfect example, a manufactured crash followed by a reverse rally that extracted billions from retail traders who were panicked out of their positions. The SEC and various senators have called for investigations into whether the Truth Social posts and the Truth API were being used to sell early access to market-moving information. A few milliseconds of lead time for an HFT firm is the difference between a normal trade and a guaranteed profit.
It feels like we're watching a massive pump and dump at the scale of a national economy. The hype around sovereign clouds and liquid-cooled high-density racks keeps the momentum going. But if you strip away the AI labels, you're left with a very traditional speculative bubble. The data center capex might reach $1 trillion by 2026, but if the actual returns on that investment, the productivity gains from AI, don't materialize at the same pace, that capital is going to evaporate. And we know who gets left holding the bag when the momentum stops.
The retail traders and the rural communities, those who lack the risk management tools to hedge against a 9.5% single-day swing, or the political capital to protect their local water supply. We're seeing a shift where 39% of planned data centers are going into counties that currently have zero experience managing these projects. These local officials are often volunteer mayors or part-time counsels who are being outmatched by the specialized lawyers and financial analysts that tech giants bring to the table. They're signing away their future for a promise of jobs that often don't exceed double digits once the construction crews leave.
It's a predatory dynamic disguised as progress. We talk about scaling and accelerating, but we rarely talk about what we're accelerating toward. If the goal is just wealth concentration through information asymmetry and resource exhaustion, then the 2025-2026 period will be remembered as a masterclass in market manipulation. The intersection of policy announcements, prediction markets, and extractive infrastructure suggests that the invisible hand is actually quite visible if you know where to look.
Exactly. The volatility isn't a side effect, it's the product. Whether it's oil futures jumping 15 minutes before an Iran announcement or the VIX averaging 20.5 in 2026, the constant state of uncertainty creates the perfect environment for profit extraction. The question for investors isn't whether AI is real, but whether the market infrastructure surrounding it is fair. Right now, the data suggests it's anything but. We have a system that rewards the leak, the algorithm, and the extractive project, while punishing the long-term holder and the local resident.
It's a stark reminder that in a market driven by momentum and insider signals, the fundamental worth of a company like NVIDIA or the utility of a data center becomes secondary to the trade itself. We're looking at a future where the most valuable commodity isn't compute power, but the foreknowledge of when the policy winds will shift. If 2026 has taught us anything, it's that the democratization of finance has mostly succeeded in creating a larger pool of people to trade against.
And that carries a massive long-term stability risk. When you have stranded assets in rural America and a retail population that feels the game is rigged, you're setting the stage for a significant regulatory and social backlash. The Liberation Day tariffs and the subsequent Great Time to Buy rally might have made billions for some, but it cost the market its credibility with millions of others. We are building a digital future on a foundation of ethical and financial debt that will eventually come due.
The tension between the trillion-dollar AI dream and the physical reality of the ground it occupies is only going to grow. As these data centers continue to compete with agriculture for water and with households for power, the AI supercycle might find its hardest limit not in the supply of chips, but in the patience of the public. The extraction can only go so far before there's nothing left to pump.
And that's the big takeaway here. For anyone watching these markets, the lesson is clear. Momentum is a powerful force, but it's often a manufactured one. Understanding that short-term volatility might be engineered and that the environmental costs are being externalized is the only way to navigate a market that seems increasingly designed to favor the few at the expense of the many. Whether it's zero DTE options or the next hyperscale data center proposal, the true price is always higher than what's on the screen.
It's about seeing the patterns before they become the headlines. The market dynamics of 2025 and 2026 have shown us that information is the ultimate leverage, and those who control the flow of information also control the flow of capital. The infrastructure of the future is being built, but we have to ask who it's really being built for. If you found these insights valuable, share this episode with someone who is trying to make sense of the current market madness.
I am your host, Trey Clark. Thanks for tuning in, and we'll see you next time at the Lounge.